Hello traders, welcome to FreeFX. I'm Francesco. I'm sorry that my camera isn't on today. I decided to switch it off because it was lagging a bit, so it's something I need to look at because it's happened in a couple of videos already. So I noticed that's been happening and I wanted to try and resolve it. But the chart we're looking at today is S&P 500 for a change, and the 4-hour is what I look at next, which is kind of the time frame that I trade on normally. But I wanted to start with the daily as a conversation about where we're at. We're positioned in a bear trend, as you know, and the daily chart shows us no difference. So we are still under the middle line, which is the 20 SMA, simple moving average, for the Bollinger Bands. And that means that we haven't really progressed beyond it. When we did do so, back here in the ending week of May, we had this kind of brief sort of crossing over and then back below it by some. That previous foray into the higher part of the Bollinger Bands lasted a good while. So we came into it on the 27th of May and we came out of it roughly the 9th of June. So about 12 days plus weekends, so 2 weeks at least. Now, what's interesting about today is that we had quite a stall this week, and then the US markets, I believe, were off on the Monday for a holiday, so we had a bit of a shorter week from the US point of view. So not much movement on Monday or Tuesday. Wednesday was a really dead zone. Yesterday quite the same, and today we had this surprise move which really happened from the US Open, so the New York Stock Exchange, which is 2:30 UK time. It's just over 4 o'clock, so all this has happened actually in the first few minutes. So I could show you that if I go down to the 4 hours, so we are in the bear trend still, that hasn't changed. If we look at the 4 hour, you can see this is the current candle which started at 2 p.m. Just before the US Open. And you can see that it really just is something of this particular candle. And then if I look even further into detail, you can see that up to 1 p.m. there really wasn't much movement at all. So we've had most of that movement from then. Now let's just go back to the daily and also look at how we are placed in terms of the indicator that I use, which is the CCI. The CCI has been picking up from the -200 on the daily. Okay, it's been picking up slowly, even as price was falling. It's been picking up, and then essentially we are now arriving closer and closer to the middle level, the zero, the neutral level, if you like. So currently we are at -33. Now, what this means is that, historically, or even just going back a few weeks, when we approach the middle level, generally we kind of revert back, or if we cross over it, then that's generally a few days or weeks of uptrend. Okay, and obviously we need to see what happens this time round. We've crossed over it, as you see there, but that wasn't a full trend reversal. So there are lots of considerations about today that I'm sure will come clearer as the day progresses and as we go into next week, which will be a full trading week. And if I wanted to also show you the weekly. On the weekly, we have picked up from the bottom of the CCI, and the candle here is quite an impressive candle. We've been in a bear market. We've been in a downtrend. The sort of bear market really is from 20% down. So we, technically speaking, that's only happened in the last few weeks, not since January. But these candles, like this week's, which is mostly fueled by today actually, because this week hasn't really moved much. But anyway, nonetheless, it's now starting to look like a bigger candle. Okay, so we've had something similar on the 23rd of May, so that week, But that obviously took us to the top of this Bollinger Band range and then further down. So we could see one of these or two, and then further downtrending. Previously in March we saw a big one there, and then tiny green ones, and then a deeper move into the red. So in terms of the CCI, you can see how we've had an attempt at sort of bouncing off the negative 200. Not quite here because we're slightly off it, but certainly we've come very close at the start of May, and then basically a week ago. And each time we sort of come back to it. So I'm not sure how far we'll come to this. We'll have to see. The monthly does seem very much still bearish. I mean, you can see that today we kind of chopped off a bit of that downward premium. Whether it's kind of short covering or not, I'm not sure. But we've taken some of that shine off that move, and we certainly have you know, a lot of movement still to come. We're going to go into July basically next week. It's going to be the kind of crossover, and we have, you know, non-farm payrolls and things like that happening as well. So the first Friday of the month will be next Friday, the 1st of July. So this Bollinger Band is obviously coming up to meet price, so I'm not sure how quickly or how steep it will be coming up. So you could argue that we've really just come shy of it, and that's it for now, and July will take us up. I think there's more room, and the reason why I say that is that we've had on a monthly 2, 3, 4, 5, 6 weeks now of downtrending. Okay, if we look back, not the pandemic crash or the downturn in 2018, which were quite short-lived moves, but if we look at the great financial crisis of 2008, okay, we had a lot more in terms of time. This sort of downtrend matured, you know, from just before 2008, just the end of 2007, and it really didn't stop until we got to the start of 2009. So it was a full year, right? Now in that case, or looking back anyway, the Bollinger Bands expanded. Okay, so once we crossed over here, the Bollinger Bands expanded, then contracted, and expanded again. In this case, they started expanding upward. It was an upward expansion, and then as we started downtrending, the bottom one has actually come up to meet the top, but it could expand again. So they're not useful in that sense, predicting, but there's still some room to go to get to the bottom of this. And then if we look at the CCI, I mean, this is not very useful for intraday trading, but just out of curiosity, we don't cross below the middle line historically very often. So you can count it on the fingers of one hand. 2008 global financial crisis, slight dip 2011, that's 2, 2015, 16, that's 3, 18, that's 4, and pandemic, that's 5. You know, so in 14 years we've had 5, and then now currently this will be the 6th. Okay, and if you discounted this one here in 2011, that would be 5. So it's not a bad signal, because it does tell you that it will continue for a while. Now, interestingly, I mentioned these, but the one that we really should be looking at, because we just said that the current situation is closer to not to a V bottom, but to what we saw in 2008. Here we crossed below, and we continued for several months, as I said, and we came down to minus 260 of the CCI. That's quite severe on a monthly chart. So if this continued, it has room to go all the way down. You know, this downtrend is not going to disappear overnight. Another thing I was going to look at as well is, this is just out of interest because obviously we've had this move today, but what I wanted to look at as well is how the WMA interacts with price. So let me just bring back the 4-hour chart there. So I use the 4-hour chart because it sort of fits my trading and my daily sort of time frame and goals, routine, and just general kind of expectations in terms of time for a trade to develop, etc. So what I really use the Bollinger Bands for is having a sense of expectations of travel. So, you know, top of the Bollinger Band as a trading entry, going down and vice versa. The middle line, the orange line, is I call it the middle line. It's basically a 20 simple moving average, 20 period. You'll notice that sometimes we sort of touch on it and sometimes we don't. It kind of depends. So try to find a better example maybe here. If we go back to this week, sort of beginning of May, you can see the price goes up to the moving average in blue. That's the 21 period weighted moving average, which is a bit more responsive, and it places more weight on the last trading period. So price doesn't go all the way up to the simple moving average, but it goes to the weighted and then it reverts. So it reverses at the WMA. So for that reason, you can see it here as well on the upside, how it interacts down here as well, 20th of May. It doesn't get up to the... So for that reason, I've just experimented and found that this is a good one to have, just sometimes too. And it works even better on the daily. If I go back and show you on the daily, you can see that prices and the WMA interact more often than price and the simple moving average, which is the middle line. So currently, looking at the daily, we have just crossed over that. So our next quote-unquote point of defense is the middle line for the Bollinger Band. So if I did a sort of free drawing tool, okay, that's a weighted, and that's the kind of less responsive simple. So this is our range, if you like. Within that range, if we stay within that, we are likely not to reverse the trend. And that range essentially would be from 3,920, let's say, to 3,840 something. So that's the area, if you like. And I could sort of go on about this, but really it's just a way to see, you know, how we can quantify that move. But I've just sort of wanted to show you that because it does help sometimes to have some kind of target or something in mind that really helps with that. In the daily as well, the CCI is coming up to the middle level. Again, it could reverse, so we need to keep an eye on the daily as well as the 4-hour. Now, it does appear that I might have talked too much already. It's just 13 minutes. I hope you've enjoyed my video. Speaking of kind of short term, I showed you the hourly there. We're starting just as I was doing the video there to see sign of exhaustion on this kind of move from the last couple of hours. And if I break it down, always worth doing this to a 5-minute to see what's happening now. We're starting to pick up a bit of a downward momentum there. Interestingly, on the 5-minute, the CCI peaked at 230, which is the US Open, and then straight away started deflating. The move continued, and now it's sort of syncing with the CCI. They're synchronizing, basically. Might be possible to view a smaller time frame, 3-minute, some kind of interaction there that might be more meaningful. Okay, we're consistently making smaller. So as we had the 3 o'clock there was the bigger of these sort of candles, the biggest of them today. And at that point, the CCI had peaked already on the 1 minute, and it started going down. So we've kind of almost flatlined on the 1 minute from that point on. Now, I'm not desperate for price to move down, although I have a short on at the moment. But I'm a bit puzzled by this move for a number of reasons, but it does happen, so there's nothing to be afraid of. However, the general trend is still to the downside, so for that reason I'm going to sit on this one and see what happens in the rest of the trading day. So let's see how it progresses. I had lots of things that I wanted to show you, one of them being the US dollar versus Japanese yen. Now, this is a really good one to gauge a number of things. So on the daily, you can see that the two charts kind of cross over. The line chart is the dollar yen and the S&P 500 in candlesticks. And the reason why they're behaving differently, obviously, is that the dollar yen is not behaving as a risk on, risk off. It's behaving as a yield differential between the dollar and the yen. So the Japanese yen is still undervalued because the central bank has not gone into a tightening cycle. They are still very much on a quantitative easing kind of bond purchasing scheme cycle, and then they do not intend to reverse that. So they're one of the most dovish banks, central banks. If you look at the Federal Reserve, if you look at the even the ECB starting to move towards rate hikes into maybe September of this year. So and other central banks as well. But essentially, that's what the USD JPY has benefited from. Not a sort of risk on, but just a sort of carry trade. And it would be interesting if I did an analysis of, let's say, something like the Kiwi dollar versus the Japanese yen, because this is the Kiwi dollar, Japanese yen. You can see that the performance of that has obviously mirrored the USD JPY. So it's been a carry trade in a certain way, but certainly it hasn't had the kind of stellar performance recently that the USD JPY has had. If you can see, I'm just trying to compare these two charts. If I take the Bollinger Bands off the SP 500, you might see that better. Okay. Now, so from this point, the Kiwi yen has peaked in April, whereas the dollar yen has continued moving higher towards the rate hikes in May. The rate hike in May, and so you can see that it's got a slightly different performance to at least this other yen cross, but I could show you others as well. They're all a bit different. So what is interesting about this is that if you listen to John Kicklighter of dailyfx.com, he will tell you that risk aversion, so a true reversal of all risk on considerations would which we're kind of moving into, because there's talk of a recession, and we've now into bear territory for the S&P 500 and the Nasdaq. Risk aversion would see something like the USD JPY generally and yen pairs generally reversing, because the carry trade is not just on the yield differential, but it's also tends to do better in a risk-on environment, whereas in a risk-off, those kind of risky assets tend to be unwound, and those gains tend to be unwound. So, in a sense, keeping an eye on something like the dollar yen, at least in his kind of view, is a way to gauge to have another signal, if you like, of things definitely picking up pace. Not that we haven't had a bearish trend so far this year, but there's still talk of maybe it's temporary, etc. It isn't, but it certainly helps to have several kind of gauges switched on. And another one might be, for example, the oil, so energy markets. If you want to look at, for example, WTI, and I'll put it on because I should have it for you. There we go. That's oil. So we've got the trade of there we go. The trade of 2020, 21 and also 22 has been oil. Crude oil has picked up considerably from those levels. You can see it's really charged higher. Now the peak here in March, there's been a bit of a move down, and we've come closer to those again. But what's interesting as well is that whereas the S&P has kind of been trading lower, we've continued to charge higher with the with crude oil. And from a monthly perspective, if we put it onto the monthly, we can see that clear picture of a parallel kind of performance until we reach March, and then a slightly different performance. Now, interestingly, recently crude oil has been also taking a turn for the worse, but that's not to say that we can't see that changing again. Could be a dip. So we just have to wait and see, but you can keep an eye on that. If it's a correlation that helps you figure out what on earth is going on, then I would sort of keep an eye on as many things as you think would help you with that. Personally, I don't really trade oil, so it doesn't really help me personally, but it's kind of interesting to have a sort of a feeler out for where the market might be going. Just looking at these things sometimes helps to see how far markets can push in one direction, or if there's an exhaustion of that. So I've covered quite a few things today. I hope you enjoyed my video. I'll see you in my next, hopefully with the camera on. Take care, and happy trading out there.